All right, the market is giving us a classic tale of two tapes. You've got powerful fundamentals clashing with some serious macro risks. So let's build a clear framework for how to position over the next 1 to 2 weeks. So on one hand, you've got this huge pile of cash on the sidelines and earnings that are just blowing past expectations. But on the other hand, we're looking at a Fed that's sounding pretty hawkish, a government shutdown that's dragging on, and some frankly ugly technical signals. Look, the only way to play this kind of market is to be smart about it. That means being selective, focusing on the right sectors, and absolutely keeping a hedge on. Okay, let's start with the bull case. The argument for more upside here is actually pretty straightforward. It really boils down to two things: earnings and liquidity. Just look at this number, $7 trillion. That's how much cash is just sitting in money market funds right now, according to the Investment Company Institute. Think about that for a second. That is a massive reservoir of buying power, just waiting. If even a fraction of that decides to rotate into equities, well, you can imagine what that does to the market. And it's not just about potential money. The fundamental support is absolutely there. We're seeing Q3 corporate earnings beat expectations at an incredible 86% rate. That's way above the historical average, by the way, based on FactSet data. And it's the big guys, your Amazons and Googles, that are really providing that solid foundation. And that's not all. On top of that, you've got some other nice tailwinds pushing things along. Q4 seasonality is, historically, the strongest time of year for stocks. The consumer is still spending, which is key. And that temporary truce in the US-China trade fight, it's taken some of that immediate worst-case scenario risk off the table for now. All right, that's the bull case. Pretty compelling. But now we have to look at the other side of the coin. The bear case is just as serious, and it's rooted in some major headwinds from policy, politics, and some, let's just say, concerning technicals. The big one here, the one you absolutely have to pay attention to, is the Fed's hawkish turn. Chair Powell came out and basically said a December rate cut is not a sure thing. He even mentioned some disagreement among the governors. The market heard that loud and clear. It pushed back those rate cut hopes, rates ticked up, and that's a direct headwind for stocks, simple as that. Then you've got the escalating risk coming out of Washington. Look, the government shutdown is now on day 34. This isn't just background political noise anymore. It's becoming a real threat. We're talking about the risk of it turning into an actual economic shutdown, messing with critical sectors like air travel. That kind of disruption could absolutely start hitting GDP numbers. And that brings me to a technical warning light that's flashing. We've recently seen a cluster of Hindenburg Omens signals. Now, let's be clear, this indicator is pretty controversial. It's known for false positives. But when you see a cluster of them together, that's generally considered more reliable. And what it signals is an increased probability, not a guarantee, but a probability of a pretty significant market drop. And finally, let's talk about sentiment, because this is a huge red flag for me. It's gotten extremely, almost ridiculously bullish. You've got reports showing active fund managers are over 100% leveraged long. They're all in and then some. And you know what that means. Historically, when everyone is this optimistic, it's a powerful contrarian signal that a pullback is often right around the corner. Okay, so we've got this major tug of war. How in the world do you translate all this conflicting data into an actual actionable playbook? Well, it all comes down to the levels. We have to watch the key levels that are going to define where this market goes next. So here's the if-then logic I'm using for the S&P 500 cash index. My base case is that we're stuck in a range. Call it support at 67.50 and resistance up at 69.12. Now, if we get a decisive break above 69.12, that's the trigger for the bull case. That's when you think about increasing long exposure. But if we fail at that resistance and then break below 67.50 support, that's your bear case trigger, and it's time to get defensive and hedged up. All right, quick pause here. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Please do your own research. This is not financial advice. Okay, let's move from analysis to execution. I'm going to walk through two risk-defined option structures that I think fit this current market environment pretty well. First up, let's talk about a potential hedge. With all those bearish signals we just went over, a put debit spread on the SPY is one way to think about protecting against a correction down to that key 67.50 support level. The thesis here is super simple: protection against a break of 67.50. The structure is a put debit spread. Why? Because it profits if the market goes down, but, and this is crucial, It caps your risk to the premium you paid for it. Now, this idea gets invalidated if the market rips higher and breaks out above resistance at 69.12. And as for sizing, that's entirely dependent on your own portfolio-specific hedging needs. All right, second idea. This one's more of a rotation thesis. We're seeing some early signs that money might be starting to flow out of some of the overextended tech names and into the energy sector. A call debit spread on XLE is one way you could potentially position for that shift. So the core idea is to position for a capital rotation from the tech ETF XLK into the energy ETF XLE. Again, a call debit spread makes sense because it gives you a risk-defined way to express a bullish view on energy. This thesis is wrong. It's invalidated if energy stocks start showing relative weakness again. With something like this, you might consider starting with a smaller position and then adding to it if you get confirmation that the rotation is actually happening. So let's wrap this all up. What's the final posture? What's the key takeaway for how to position in this really complex market? Here it is, the most crucial point. You can't just blindly buy this market right now. You have to be selective, focus on companies with proven, strong earnings. You have to be sector-focused, keep an eye out for those rotations and where the relative strength is. And most importantly, you have to be hedged. You have to respect the very real macro and technical risks we've talked about. And that leaves us with the final critical question. You've got a record $7 trillion in cash sitting on the sidelines, but you've also got some very serious risks mounting. So is your portfolio positioned for the breakout to new highs or for the breakdown below key support? And one last time, this is not trading advice. It's just a market update to keep you informed. All markets carry risk. Always trade your own plan, manage your downside, and please verify all data for yourself.